The average American says they'll retire at 66. Reality? They're usually out by 61. And no, that is not some cute little planning mismatch. That's layoffs, health problems, caregiving chaos, reorgs, all the stuff people don't budget for. Because, well, it's not fun to imagine. But if you're 48, this is exactly why the next decade matters so much. Because there are a few ages where money gets weird in a very specific way, and 48 is one of them. Not 40, that's when people start panicking. Not 50, that's when people start pretending they've got it figured out. 48 is the real hinge point. It's the last stretch where peak earnings, enough compounding runway, tax moves, and a still possible career exit all overlap at the same time. That overlap matters. At 45, a lot of people haven't fully hit their top income years yet. At 52, some of the dangerous retirement math is already closing in. But right here, right now, if you're 48, you're sitting in the sweet spot where the biggest decisions still have time to work. And I want to show you why this age changes your financial future in a very real, not theoretical way. We're going to walk through 4 things. First, why your income is probably near its peak. Second, why every extra year you wait has a huge compounding cost. Third, why a lot of workers get pushed out before they plan to retire. And fourth, why the years between now and your mid-50s are not just more saving time, but a totally different financial phase. Miss one of these and the math starts quietly working against you. Sneaky little thing. Let me use an analogy here. In aviation, there's a concept called escape velocity. That's the speed a rocket needs to break free from gravity. Go too slow, and no matter how good the engine is, you don't escape. You fall back. Your financial life has something like that too. Not from gravity, obviously. From time, taxes, and compounding. And the burn phase, the part where your decisions really shape the outcome, is roughly from 45 to 55. Which means 48 is smack in the center of the window where the trajectory gets locked in. In a minute, I'm going to show you the part of retirement planning that most people never really talk about. How being forced out of work and sequence of returns risk can team up and wreck an otherwise decent retirement plan. But first, let's talk about your biggest asset right now and the blind spot hiding inside it. According to ADP payroll data across more than 110 million active records, the highest median wage in the US belongs to workers age 45 to 54. That median is $97,600, highest in the whole data set. PayScale also found that college-educated men tend to keep seeing earnings growth longer than most, with income peaking around age 49 at roughly $90,000. And Federal Reserve data says households between 45 and 54 have a median income of $91,880. Again, the highest of any age group. So statistically, if you're 48, you're probably very close to the most money you'll ever make. That's the good news. Here's the part nobody likes to say out loud. Peak income years are also peak expense years for a lot of people. Mortgage, kids, tuition. The lifestyle upgrades you made when you were climbing, yeah, those have a nasty habit of becoming the new baseline. That's what people politely call lifestyle inflation. I call it the reason so many high earners feel busy, successful, and somehow still weirdly behind. At 48, a lot of people are earning more than ever and saving less, proportionally, than they did in their 30s. Back when the paycheck was smaller, but the percentage going to savings was actually better. Funny how that works. Empower looked at account data and found that Americans in their 40s have an average retirement balance of $593,000, but the median is only $220,000. And that's the number that matters more, because the median is what the middle actually looks like. Now, if you take $220,000 and let it compound at a 7% real return for 17 years, it lands around $650,000 by retirement.
Under the 4% rule, that's about $26,000 a year. Add average Social Security of roughly $22,000, and you're at about $48,000 in annual income before taxes. And that's before healthcare starts chewing through the budget, which, yeah, can easily run over $10,000 a year. So, no, the real issue is not just earnings. The real issue is what you do with them. Let me make this real. Imagine a guy named Mark. He's 48, makes $92,000 a year, has $280,000 in a traditional 401k, no Roth, owns his home, no credit card debt, about $6,000 in savings, and he truly thinks he's on track to retire at 65. On paper, that looks fine. He's contributing 15% to retirement, including the company match. He's not a disaster, he's not reckless. In fact, he's doing what most planners would have told him was solid, like 15 years ago. That's the problem. Mark is making 3 structural mistakes that could cost him between $250,000 and $400,000 over his lifetime. Not because he's lazy or bad with money, because his setup belongs to an older version of retirement planning. We'll come back to Mark. He gets a resolution. But first, let's talk compounding, because this part is brutal. If you invest $1 today and earn 7% annually, in 17 years, that dollar becomes about $3.38. Wait 7 years before investing it, and by retirement, it's only about $1.75. Same dollar, very different outcome. You didn't make a bad investment. You just made a late one. Now, scale that up. If you increase your annual retirement contributions by $20,000 starting at 48 versus starting at 55, the difference at age 65 is not just $140,000. Because compounding stacks on itself, the real gap is closer to $450,000 to $500,000. That's not a small miss. That's a totally different retirement life. And the government has actually built some useful tools into this exact period, which a lot of people don't fully use. In 2026, workers age 50 and older can contribute up to $32,500 to a 401k, $24,500 base, plus an $8,000 catch-up contribution.
And Secure 2.0 added a bigger catch-up window for ages 60 through 63, where the catch-up jumps to $11,250, bringing the total maximum to $35,750. That's a real advantage. But here's the catch. The people who can actually use that super catch-up at 61, 62, and 63 are the people who spent their late 40s and 50s building the margin to support it. If you reach 60 and you're just barely scraping by on the standard contribution amount, that enhanced catch-up doesn't help much. It's a feature for the people who prepared for it. The runway at 48 determines whether you can use the runway at 62. And yes, if you're liking this kind of breakdown, hit subscribe. Otherwise, the algorithm may decide you only deserve dancing debt videos and random side hustle hype, which, honestly, rude. Now let's connect compounding to sequence of returns risk, because these are not separate problems. They're basically the same movie, different scene. At 48, you're still in accumulation mode. That means market dips are actually your friend. When prices fall, you're buying cheaper. During working years, the order of returns doesn't matter nearly as much. A 20% drop followed by a 25% gain ends up around the same place as the reverse, because you're not taking money out. But once withdrawals start, totally different story. Wade Pfau's research found that about 77% of a portfolio's final retirement outcome can be explained by the returns in just the first 10 years of retirement, not the whole lifetime average, the first decade. That's the part people miss. The order matters more than the average. A 20% decline on $1 million portfolio means a $200,000 hit. On a $400,000 portfolio, it's only $80,000. Same percentage, different pain level. Early retirement is when the portfolio is at its largest and withdrawals are starting. So a bad market then does the most damage it can ever do. And if you're forced to sell assets to fund living expenses during that downturn, those shares are gone. They don't get to participate in the recovery. That's the ugly little math trap. 2 retirees can both average 7% over 30 years. One runs out of money in year 23. The other still has $800,000 at the end. Same average return, completely different life. The only difference is the sequence. Now add in the fact that a lot of people don't actually work until the retirement age they planned. This part is kind of grim, but it matters.
ProPublica and the Urban Institute studied the Health and Retirement Study, which followed 20,000 people from age 50 onward. Their finding? 56% of stable, long-time employees were laid off or pushed out under financially damaging circumstances before they voluntarily retired. More than half. And another 13% left in a way that suggested it was really forced, even if they labeled it voluntary to avoid the stigma. So the real number may be even worse. Harvard's Lisa Berkman has called the 50s the fork decade, because that's when a lot of people don't make it through full-time work the way they expected to. Let that sit next to sequence of returns risk for a second. You think you'll retire at 65, but data says there's a decent chance you get nudged out at 53, 56, or after a health issue at 58. Now your withdrawal phase starts earlier than planned. Then a market drop shows up, because markets do that. Now you're drawing from the portfolio while it's down. You're selling low to pay bills. The recovery comes later, but it grows a smaller portfolio. That's how plans unravel. And the people who survive this aren't lucky. They had buffers in place 7 to 12 years earlier, before the pressure hit. Those buffers are pretty specific. First, a cash or high-quality bond reserve covering 2 to 4 years of living expenses. Second, a guaranteed income floor. Social Security, maybe a pension, maybe an annuity if that fits your situation, so the portfolio isn't carrying the entire survival load.
Third, a tax-diversified account structure. So in down markets, you can pull from Roth or taxable accounts instead of being forced to sell your pre-tax accounts at the worst possible time. And none of those can be built overnight. They take years, which is why 48 matters so much. You still have time. Now, let's talk about the part of retirement that people underestimate the most, healthcare. This is where a lot of projections get weirdly optimistic for no good reason. In 2026, the enhanced ACA premium tax credits that had been available since 2021 expired and were not renewed. So the subsidy cliff at 400% of the federal poverty level is back. For a single person, that's around $62,600. Go above that and you pay full price for marketplace coverage. For a 63-year-old in many regions, benchmark silver plans can run around $1,400 to $1,500 per month. That's about $16,800 to $18,000 a year just in premiums, before deductibles, before copays, before prescriptions. If you leave work at 61 and Medicare doesn't start until 65, that's 4 years of private insurance. At those levels, you could be looking at around $68,000 in premiums alone over that stretch. And that's assuming prices don't rise, which would be optimistic. And surveys from the National Council on Aging say only 48% of people explicitly account for higher healthcare costs in retirement planning. That's not ideal. The best structural answer here is the HSA. If you have access to a high-deductible health plan, the 2026 family HSA contribution limit is $8,550. That money is tax-deductible going in, grows tax-free, and comes out tax-free for qualified medical expenses. That's the rare triple tax advantage. There isn't another U.S. account that gives you all three at once. And after age 65, you can use HSA funds for anything. If it's not medical, you just pay ordinary income tax, which basically turns it into a mini IRA. But the real move is not to drain it on current medical bills if you can avoid it. Let it compound. Pay current expenses out of pocket if that's possible. Let the HSA sit there and quietly build. If you do that, you can arrive at retirement with something like $60,000 to $90,000 in tax-free medical reserves. That can absorb the insurance gap without wrecking your portfolio. Here's the twist that catches most people off guard. The problem usually isn't that you didn't save enough. It's that you saved everything in one tax bucket. Most people end up with a giant pre-tax 401k, maybe a little cash, and no real tax flexibility. That means their retirement outcome depends on tax rates, market timing, and exit timing all lining up nicely, which is a bold assumption, honestly. So let's go back to Mark and unpack his 3 mistakes. Mistake 1, the single bucket trap. He has $280,000 in a traditional 401k and basically nothing else. That means every dollar is going to be taxed as ordinary income later. He's assuming retirement taxes will be lower than his current taxes. Maybe, maybe not.
When required minimum distributions begin at 73, he'll be forced to withdraw money whether he wants to or not. If his account grows as expected, those RMDs could start around $28,000 in year one. Add Social Security of roughly $22,000, and he's already at about $50,000 in taxable income. That could put him in the 22% bracket, which is not a huge drop from where he is now. And if tax rates rise over time, that gap may get even smaller. So the fix is tax diversification. A Roth IRA if he's eligible, a backdoor Roth if he isn't, maybe a taxable brokerage account for capital gains treatment. Maybe a Roth conversion strategy that fills the 22% bracket without spilling into 24%. Nothing exotic, just different account architecture. Mistake 2, no real liquid buffer. $6,000 in savings is not a buffer. That's a speed bump. If Mark has a mortgage, a family, and a house that will eventually need a roof, then one unexpected car repair or medical bill can force him into a 401k withdrawal.
And if he touches that money before 59.5, there's a 10% early withdrawal penalty on top of ordinary income tax. So a $30,000 emergency withdrawal in the 24% bracket can cost around $10,200 right away. That's a huge chunk disappearing before he even gets the cash. That's why a 6-month emergency fund in liquid, penalty-free assets is not optional. It's what keeps one bad month from turning into a permanent retirement wound. Mistake 3, he hasn't modeled the insurance gap. He's assuming he works until 65, keeps benefits, and slides neatly into Medicare. The data says that exact story is less likely than people think. He hasn't priced the ACA, he has no HSA, he hasn't planned for the possibility of leaving work at 61 instead of 65. That's a big miss, because 4 years of private coverage can blow up a perfectly decent retirement plan. Now, let's make this concrete with another example. Karen is 48. Household income is $100,000. She has $250,000 in a traditional 401k. No Roth, no HSA, and about $5,000 in savings. Same story a lot of people have. She's contributing 15% and thinking she'll retire at 65. Scenario 1, she changes nothing. At 65, her 401k grows to around $760,000 top, assuming 7% annual returns. At 73, required minimum distributions force about $30,000 a year out of the account. Add Social Security, and her gross retirement income lands around $52,000. After taxes and Medicare premiums, she nets around $40,000. First-year Medicare costs, including Parts B and D plus supplemental coverage, are around $8,000. So she's left with about $32,000 of discretionary retirement income. Technically fine. Emotionally, not exactly luxurious. Scenario 2. She starts making small but strategic moves at 48. She redirects $150 a month into a Roth IRA. That's $1,800 a year. She opens an HSA and contributes the maximum, then leaves it alone. She also builds a 6-month emergency fund of $25,000 over the next few years. And she prices the forced exit insurance gap so she can actually see the number she's planning for. By 65, her 401k may be a little smaller than in scenario 1 because she moved some money around. But now she also has about $75,000 in Roth assets and around $90,000 in HSA funds that have compounded for 17 years untouched. In down markets, she can tap the Roth instead of selling investments at a loss. Her HSA covers healthcare costs, which keeps taxable income lower. That helps with Social Security taxation too. The difference between those two lives is not some giant income leap. It's about $300 a month and a few account choices. That's it. And the wealth difference can still land somewhere between $150,000 and $250,000, depending on market conditions and tax rates. Same income, different structure, very different future. And this is the part where I'll say something slightly annoying but very true. Compounding does not care whether you're building wealth or quietly eroding it. It just compounds whatever you give it. Now, knowing all of this and actually building a system around it are two different things. I learned that the hard way, honestly. You can know the numbers and still not change anything until you have a framework that tells you what to do first, what to measure, and where the real pressure points are.
That's why I built the Exit Code, a digital book that turns decades of retirement data into a practical framework for exiting on your terms. It covers the two things we just talked about in a lot more detail: the hidden insurance gap between 62 and 65, and a dynamic withdrawal method that's built to handle sequence of returns risk instead of pretending it doesn't exist. 8 chapters, no fluff, all data, no nonsense. You can grab it through the link in the description. And now back to the bigger picture. You'll hear a lot of people online tell 48-year-olds to start a side hustle and retire in 3 years. Cute idea. I admire the confidence.
But I prefer math. Here's the actual frame. The average American plans to retire at 66, leaves work at 61, and then spends the next few years burning through savings faster than expected because the insurance gap, tax drag, and market timing risk were never truly modeled. That outcome usually isn't caused by low income alone. It's caused by structural decisions that were never made during the exact window when they still had time to compound. Not because the information didn't exist, because nobody gave it to them when it mattered. Your employer benefits packet is not going to warn you about sequence of returns risk. Your 401k statement is not going to tell you that 77% of retirement success is shaped by the first decade after you stop working. And a financial advisor charging 1% of assets a year has every reason to make this all feel gradual and manageable instead of urgent and mechanical. So let me leave you with 3 moves that are specifically about 48. First, model the forced exit this week. Don't guess. Pull your Social Security estimate at 62, 66, and 70. Then price health insurance for a 62-year-old in your zip code through healthcare.gov. In 2026, that number is likely well above $12,000 a year in premiums alone. Compare that against your current plan, assuming you stop at 61. If the math works, great. If it doesn't, now you know the gap. Second, build tax diversification within the next 3 years. If 90% or more of your savings is in a traditional pre-tax account, you're betting everything on one tax outcome. Open a Roth IRA if you can. If you're over the income limit, ask a tax pro about a backdoor Roth. You don't need to convert everything, you just need the Roth clock started so future you has more flexibility. Third, treat the HSA like your second 401k. If you have access to a high-deductible health plan, it's one of the best accounts in the tax code. In 2026, family contribution limit is $8,550. Tax-deductible, tax-free growth, tax-free medical withdrawals. Let it compound. If you can afford to pay current medical bills out of pocket, do that instead. An $8,000 annual HSA contribution compounding at 7% for 17 years can grow to around $255,000, all available tax-free for medical expenses. That's a pretty beautiful safety net, honestly. Those 3 moves do not require a higher income. They require structure. And if you're wondering what happened to Mark, here's the answer. He ran the forced exit scenario, saw the math break at 61, opened a Roth IRA, started the backdoor process, and finally used his company's HDHP to get into an HDHP at 48. He still has time. That's the whole point. The escape velocity window is open. Not forever, but right now, yes, it's open. And for the record, lazy investing has created more wealth than most people want to admit. Also, only about 5% of American households have $1 million or more saved for retirement. So the window was always there for the other 95%. The missing piece was usually the architecture.